In 1984, fewer than 1 in 10 people collecting Social Security ever paid $1 of federal tax on it. Today, that number is close to 1 in 2. No new law caused that shift. No vote was taken to raise anyone's taxes. The income lines that decide who pays simply never moved, not once, in more than 40 years, while everything else in a retiree's life kept climbing. That single frozen number is quietly pulling millions of ordinary retirees into paying tax on income they were never meant to owe a cent on. But here is what almost nobody realizes while they're staring at that shrinking check. The tax code also contains the opposite of that story. Several categories of income the IRS has no legal claim to at all, not reduced, not deferred, simply untouchable. Most retirees know about one of them, maybe two. There are 8. In this video, I am going to walk you through every one of them in plain language, including the very last category, which almost nobody believes could possibly apply to them, and they are wrong. If you or someone in your household ever served in the military, stay through to that one specifically, because it may be the single largest piece of tax-free income on this entire list, and it rarely comes up in any conversation about retirement taxes at all. My name is Nolan Carter. I study exactly this kind of thing, the categories, thresholds, and quiet rules buried in the tax code that determine how much of a retiree's income the government is legally allowed to touch and how much it simply isn't. I am not here to sell you a strategy or a product today. I am here to walk you through what the law already says is yours to keep. Before we get into the 8 categories, if this is useful to you, take a moment and subscribe. This channel exists to explain exactly this kind of thing in plain language. The parts of the tax code that quietly work in your favor if you know they exist, and subscribing means you catch the next one before tax season catches you off guard instead. And stay through to the end, because after we cover all 8 categories, I am going to give you a simple, free way to work through your own accounts and figure out exactly which of these apply to you. So none of this depends on trying to remember 8 categories on your own. Let's start with the one most people have at least heard the name of, but almost nobody understands completely, because there are actually 2 separate advantages hiding inside it, and most people only know about one. Category 1 is the Roth account. A qualified distribution from a Roth IRA is not income you settle up with the IRS later. It is not deferred. It is simply not taxable income at all, and the government has no legal claim to it. That is the foundation everyone already knows. Here is the part almost nobody explains. A Roth distribution is only tax-free if the account has been open for at least 5 years and you are at least 59.5 years old. If you converted a traditional IRA into a Roth a few years back, that conversion starts its own separate 5-year clock apart from your original account. Withdraw too soon after a late conversion and the money still comes out, but the tax bill comes with it. Here is why this matters differently depending on where you are starting from. If you are living mostly on Social Security with a modest IRA, a Roth conversion handled carefully during a lower income year can permanently move future growth completely out of the IRS's reach. If you already have a larger account balance, the 5-year rule becomes something you plan around rather than something that stops you, because you have time to stage conversions deliberately, a portion at a time. One more detail matters just as much. There are no required minimum distributions from a Roth account during your lifetime. At age 73, the IRS forces withdrawals out of traditional IRAs and 401k plans whether you need the money that year or not, and those forced withdrawals are fully taxable. A Roth carries no such requirement. You decide when the money comes out, or whether it comes out at all while you're alive. And while we're on the subject of those forced withdrawals, there is a related move worth knowing if you are 70.5 or older and give to charity. It is called a qualified charitable distribution. You can send money directly from a traditional IRA to a qualified charity, and that transfer counts toward your required minimum distribution without ever appearing as taxable income on your return. It never touches your adjusted gross income, which means it never touches your Social Security calculation or your Medicare premium either. Most people write a check to charity from their bank account after the distribution has already been taxed. Routing it directly from the IRA instead means that portion is never taxed in the first place. One more piece worth knowing before we move on. Once you turn 65, your standard deduction increases automatically, no form, no election, nothing to track. It stacks on top of everything else on this list, quietly shrinking your taxable income regardless of which category that income came from. That brings us into category 2 because it works on the income calculation itself, just through a different type of asset. Municipal bond interest is excluded from federal gross income under the tax code. Not deferred, not discounted, simply not counted as your income at all. And in many states, bonds issued by your own state also come free of state income tax. If a portion of a retiree's income runs through qualifying municipal bonds instead of a taxable bond fund or a savings account, that interest never enters the taxable income calculation at all. It does not affect the Social Security threshold. It does not affect the Medicare premium calculation. It is real money landing in the account that simply is not there for tax purposes. For someone on a lower income, municipal bonds sometimes pay a lower nominal rate than taxable alternatives. But once you compare them after tax, the math still frequently favors the municipal option depending on your bracket. For someone in a higher bracket, the equivalent taxable yield on municipal bonds often exceeds what a taxable bond pays after the IRS takes its share, and that gap widens the higher your ordinary income climbs. Here is one honest caveat worth knowing before you lean on this one too heavily. While municipal bond interest is exempt from income tax, it still gets added back in when the IRS calculates whether your Social Security benefit gets taxed, the same calculation we are about to walk through in detail. Municipal bonds work best when your income sits comfortably above or comfortably below those thresholds, with real room to spare. If you are sitting right on that line, loading up on municipal bonds can actually push you over it. Run the numbers before committing a large amount. There is a related piece worth checking that has nothing to do with federal law at all: your own state. A number of states do not tax retirement income the way the federal government does. Some exempt Social Security entirely at the state level. Others exclude a portion of pension or IRA income once you cross a certain age. A handful have no state income tax whatsoever. None of this changes what the IRS does with your federal return, but it changes your total tax bill, and it is worth checking your own state's treatment of retirement income specifically, since it is rarely identical to how that same state treats a paycheck from a job. Now let's move into a category that surprises people, because it does not feel like income at all when it lands in your account, and the IRS agrees. It genuinely is not. Category 3 is gifts and inheritances. And this is where people miscalculate in a way that costs them real peace of mind for no reason at all. Under federal tax law, gifts and inheritances are excluded from the recipient's gross income entirely. If your adult children give you money, that money is not your taxable income. If you inherit cash or assets from a parent or a sibling, that inheritance is not your taxable income either. The IRS simply has no authority to reach those dollars on the receiving end. For 2026, the annual gift exclusion is $19,000 per person per giver. A married couple with 2 adult children could receive up to $76,000 in a single calendar year in gifts, with 0 federal income tax owed by anyone receiving it. For inherited assets, there is a second layer that matters just as much. The cost basis steps up to the fair market value on the date of death. If a sibling held stock for 30 years that grew from $10 a share to $90 and left it to you, your basis becomes $90. You do not inherit 30 years of their taxable gain. It is simply erased. There is one important exception, and it is the one that trips families up the most. An inherited traditional IRA or 401k does not get this treatment. That money was never taxed going in, so the IRS collects when it comes out, and heirs generally have to empty the account within 10 years, paying ordinary income tax on every dollar, often during their own highest earning years. Leaving a taxable brokerage account to your children can mean they owe almost nothing after the step up. Leaving that same amount sitting in a traditional IRA can mean handing a meaningful share of it straight to the IRS instead. Consider a retired nurse who inherited $41,000 in cash from her mother's estate and separately received a $19,000 gift from her 2 adult children in the same calendar year. $60,000 arrived in her account within 12 months, and she owed 0 federal income tax on any of it because none of it was ever counted as her gross income to begin with. She did not do anything complicated. She simply knew the rule existed. Receiving a gift or an inheritance also does not affect your Social Security benefit calculation, and it does not count toward the provisional income formula we are about to walk through. One guardrail worth knowing, though, gifts are invisible to the IRS, but not to Medicaid. If long-term care might be part of your future, Medicaid looks back 5 years at money that has been given away, and large gifts can create a penalty there, even though the IRS never blinks at them. The tax answer and the Medicaid answer are 2 completely separate questions, and it is worth knowing which one you are actually asking. Category 4 is life insurance, and there are 2 distinct advantages hiding inside it. Most people only know one of them. A death benefit paid to a beneficiary arrives completely income tax-free. That much is common knowledge. The living strategy is the one almost nobody uses. If you hold a permanent life insurance policy with accumulated cash value, you can borrow against that cash value, and the loan itself is not taxable income. You are not withdrawing the money, you are borrowing against an asset you already own, and as long as the policy stays in force, the IRS has no claim on those loan proceeds at all. This becomes a genuine planning tool. In a year when an ordinary IRA withdrawal would push you into a higher taxation tier on your Social Security or trigger a Medicare surcharge, a policy loan gives you access to cash without adding a single dollar to your taxable income. Your Social Security stays partially or fully protected, and your Medicare premium the following cycle gets calculated on a lower number since Medicare's income-based surcharges look back 2 full years at your tax return. One caveat responsible planning requires you to know: a policy loan is not free money. Interest accrues on the balance, and if the loan plus interest ever grows larger than the policy's cash value, the policy can lapse. And if it lapses while a loan is outstanding, the amount above what you originally paid in can become taxable all at once, on top of losing the death benefit entirely. This tool works well when it is monitored, typically alongside your insurance carrier or a financial professional keeping an eye on the loan balance relative to the cash value. It is a genuinely useful strategy. It is simply not a walk away and forget about it one. Now, let's get into the category where the most expensive misunderstandings happen, the one tied to that frozen threshold from the very start of this video, and the one where a single careless withdrawal can quietly pull thousands of untaxed dollars into the tax system in one afternoon. Category 5 is the Social Security partial exclusion, and this is where everything from the start of this video connects. At minimum, 15% of your Social Security benefit is always tax-free at every income level, no exceptions. For a large share of retirees, the exclusion is far larger than that. Here is the formula the IRS actually uses. It is called provisional income, and it equals your adjusted gross income, plus any tax-exempt interest, plus half of your annual Social Security benefit. For a single filer, if that number sits below $25,000, none of your Social Security is taxable. Between $25,000 and $34,000, up to half of it can become taxable. Above $34,000, up to 85% can become taxable. For a married couple filing jointly, those same lines sit at $32,000 and $44,000. And here is the detail from the very beginning of this video. Those exact numbers were set decades ago, and they have never once been adjusted for inflation. A retiree earning what once counted as a modest income now regularly crosses a line that was written for a completely different economy. Picture a retiree who draws a large traditional IRA withdrawal without thinking about the sequence. Their provisional income climbs well past that upper threshold, and 85% of their Social Security becomes taxable, purely because of how that one withdrawal was timed, not because they earned more money overall that year. Now picture the same retiree using everything covered so far. Roth distributions do not count toward provisional income. Municipal bond interest does not count toward this specific calculation, once you have already checked it against the caveat we covered earlier. Policy loan proceeds do not count. Gifts and inheritances do not count. Draw from those sources first. Stage traditional IRA withdrawals carefully, and lean on a policy loan in a higher income year. And the same total income can land completely below the threshold. The outcome is not luck, it is sequencing. And sequencing is very often the entire difference between paying tax on 85% of a Social Security check and paying tax on none of it at all. Category 6 is one most retirees already have access to and rarely use to its full potential, a health savings account. It is the only account in the entire tax code with 3 tax advantages stacked on top of each other at once. Contributions are deductible going in, growth inside the account is completely tax-free. Withdrawals used for qualified medical expenses come out tax-free as well. No other account in the federal tax code works quite like it. The mistake most people make is using the account immediately, paying today's medical bills with today's HSA funds as they arrive. That is a legal use of the account, but it is not the most powerful one. The IRS places no time limit on HSA reimbursements. You can pay a medical expense out of your own pocket today, keep the receipt, let the account continue growing completely tax-free for years, and reimburse yourself from that account a decade later. The reimbursement is still entirely tax-free, and the money sat there growing untaxed the whole time you waited. There is also a detail worth knowing once you are on Medicare. HSA funds can be used to pay your Medicare Part B, Part D, and Medicare Advantage premiums completely tax-free. That is a bill most retirees pay directly out of a Social Security check using money that has already been taxed once. Paying it from the HSA instead means covering it with money that was never taxed and never will be. 2 boundaries worth knowing. To contribute new money to an HSA, you need to be enrolled in a qualifying, high-deductible health plan. And once you enroll in Medicare, new contributions stop, though whatever is already sitting inside the account keeps growing tax-free indefinitely, and you can still spend it. And anyone 55 or older can add a modest catch-up contribution on top of the standard yearly limit, worth doing every year you remain eligible. Now here is Category 7, and it requires no account, no enrollment, and no form filed in advance. It is called cost basis recovery, and the concept is simple once you actually see it. When you invest after-tax money into an asset, that original amount is your basis, and you already paid income tax on it once, the year you earned it. When you later sell or withdraw from that asset, the portion representing your original basis is never taxable again, because the IRS already collected on that exact dollar the first time around. This shows up in 3 common situations. In a non-qualified annuity funded with after-tax money, gains come out first and get taxed, and once those gains are fully paid out, the remainder, your original basis, comes out completely tax-free. In an after-tax brokerage account, only the gain above your original purchase price is taxable when you sell. And with real estate, your basis includes your original purchase price plus any documented capital improvements, and only the gain above that combined number is subject to capital gains tax at all. Consider a retired contractor who sold a rental property he had owned for over 20 years. His sale price was $310,000. His original purchase price was $95,000, and his documented capital improvements over the years added up to $47,000 more, putting his real cost basis at $142,000. His taxable gain was $168,000, not $215,000. The difference, $47,000, was money the IRS had no legal claim to because he had kept every invoice and every permit for over 2 decades in a single folder. This category is missed constantly, not because it is complicated, but because the paperwork gets lost. Old brokerage statements disappear. Annuity contribution records go unfiled. Improvement receipts for a home bought decades ago vanish entirely. When the asset eventually gets sold, the whole amount looks like taxable gain simply because there is no documented basis left to subtract from it. Take a moment now and subscribe if this has been useful so far, because the eighth and final category is the one I promised you at the very start, the one that almost nobody believes applies to them. And if anyone in your household ever served in the military, this next part may be the single largest number on this entire list. Category 8 is VA disability compensation, and it may be the single largest source of completely tax-free income most people never even think to look for, because most people assume every kind of government payment eventually gets taxed somewhere. This one never does. If you or a spouse ever served in the military and received a service-connected disability rating from the Department of Veterans Affairs, that monthly compensation is completely excluded from federal gross income, and in nearly every state, it is exempt from state income tax as well. There is no income threshold, there is no phase-out at higher amounts. It does not matter whether the rating is 10% or 100%. It is not reported on any tax form, it does not appear on a 1099, and it never touches your tax return in any way. Here is the number worth sitting with. A veteran with a full disability rating can receive well over $3,000 a month in compensation, more than $45,000 a year, and every single dollar of it arrives completely untouched by the IRS. Cost of living increases to that amount are tax-free as well. Retroactive payments, if a rating is increased after the fact, are tax-free too. None of it interacts with the Social Security thresholds we walked through earlier, and unlike some other benefits on this list, there is no annual limit capping how much of it stays tax-free. Many veterans do not realize this benefit exists for them, or they assume it applies only to younger veterans, not to someone who served decades ago and only recently filed a claim for a condition connected to that service. A hearing issue, a joint problem, a service-connected condition that developed years after discharge, these can all qualify for a rating filed today, regardless of how long ago the service happened. If you or your spouse served and have never looked into whether a condition might qualify for a disability rating, that alone is worth 10 minutes with the Department of Veterans Affairs to find out. Now let's bring all 8 of these together into a simple list you can work through this week. First, list every account and asset you hold and classify it: traditional IRA, Roth, after-tax brokerage, HSA, annuity, municipal bonds, or property. Second, track down your cost basis documentation for every after-tax account, annuity, and property you own, and if you cannot find it, request it in writing from your brokerage or insurance company today. Third, calculate your own provisional income using last year's return, adjusted gross income plus tax-exempt interest plus half your Social Security benefit, and compare it honestly to the $25,000 or $32,000 threshold. Fourth, pull your most recent Medicare premium notice and check whether a surcharge is being applied, and if so, trace it back to the income that caused it 2 years ago. Fifth, if you are charitably inclined and past the age where required withdrawals apply, look into routing next year's donation directly from your IRA instead of writing a check after the money has already been taxed. Sixth, start a folder, physical or digital, for HSA receipts and property improvement records going forward, since every one becomes a future tax-free reimbursement or a lower taxable gain down the road. And seventh, if you or a spouse ever served in the military, take 10 minutes and check whether a VA disability rating applies to you, even for a condition that developed well after your service ended. I put together a simple one-page checklist that walks through all 8 of these categories and exactly what to gather for each one, so none of this depends on remembering a video. It is free, and the link is in the description below. One honest note before we close: this is general education, not personal tax or legal advice. Every one of these categories has details that depend on your specific accounts, your income, and your state, so always confirm your own situation with a qualified tax professional before making decisions based on anything covered here. None of these 8 categories require special access or a particular net worth. They are written into the tax code, published, and available to anyone willing to read the fine print. Most people simply never get handed. You do not need to fix all 8 at once. Pick one, put it in place, and move to the next one next year. If this helped you see income you did not realize was already protected, share it with one person, a sibling, a neighbor, a fellow veteran, someone who could use exactly this. And if you want the next update on taxes, Social Security, and retirement income caught before it costs you anything, subscribe to this channel. I will see you in the next one.